Welcome. Have you ever wondered how businesses keep track of their finances? It all comes down to a fundamental process known as the accounting cycle. The accounting cycle is a systematic series of steps used to record, organize, and analyze financial transactions during a specific reporting period. Let us break it down. First, we identify and analyze transactions. Every sale, purchase, or expense must be backed by source documents like receipts or invoices. Next, we record these transactions in a journal using strict accounting rules. Debits and credits must always balance. Third, we post these journal entries to the general ledger. The ledger categorizes everything by account, giving a clear view of where money is going. Fourth, we prepare an unadjusted trial balance. This ensures our total debits equal our total credits before moving forward. But wait, we are not done yet. Step 5 involves adjusting entries. We update accounts for accrued expenses or revenues that have not been recorded yet. Step 6 is the adjusted trial balance, verifying everything is balanced after our adjustments. Now comes the most important part for stakeholders. Step 7. We use the adjusted trial balance to create financial statements, including the income statement, balance sheet, and cash flow statement. These documents show the overall health of the business. Finally, Step 8 is closing the books. Temporary accounts like revenues and expenses are zeroed out and transferred to permanent equity accounts, preparing the business for a brand new accounting period. By following this entire cycle, companies maintain accurate, transparent records, ensuring smart decisions and overall compliance. That is the accounting cycle completely simplified for everyone.